Are we back? We're back. Okay. Welcome back to my channel, Dan Weston's something maybe. I'll change the name. Who knows? Doesn't matter. So we're gonna go over I'm trying to do some more fun topics. Like I find topics interesting to research sometimes and comes up through discussions and things I see online. So this is kind of something I've always thought of, like how many stocks should you own? Okay. So we're talking about individual stocks. I'm going to be more focused on US stock portfolio diversification because I understand in international, I think is different from the research I looked at. So we're more focused on the US side. So how many stocks should you own? Why should you own more than five? Should you own 1,000? That sounds crazy, but why should you own more? So start off here is a Reddit page. Someone just asked, how many stocks are in your portfolio? So just to start, what do people have? Okay, let's see. Um, this guy, 4 to 8. Okay, we are super concentrated. So benefits of that could be that he has plenty of time to research 4 to 8 companies. Maybe he's working. That's all he feels comfortable investing in. Maybe that's all he's found that is of interest to him. So he's very concentrated. Okay, and it'll be more a discussion about why that could be bad. This guy, 4 combined for 75% of his portfolio. Okay. So that's very concentrated. This guy, 16. Um, okay, S&P. Well, obviously, if you own the S&P, you have 500 holdings. So that's pretty diversified to me. Let's see one more. 1043. Okay. So we've got answers of like 5 to 43. Okay. Seems to be some sort of consensus. Any others? 5, 9, 5, 3. Okay. So individual stocks, I've always people probably hold somewhere in the 5 to 40 range. From what I've seen, is pretty typical. 5 to 40. So what does this matter to you as an investor? Why do you even care about diversification? Well, let's go to good old Investopedia. Diversification, owning a wide variety of investments and different characterizations. Okay, now this is talking about diversification of stocks, bonds, real estate, ETFs, commodities. We're not talking about that right now. So let's focus more on how many individual stocks you should own. So we're going to move on. I'm going to play a clip. This is one of my favorite channels, Gen X Dividend Investor. He did a video on this a few years ago. So we'll have his definition of diversification because it's much better than mine.
Associated with a particular company or industry. Investors are unable to diversify away systematic risk, such as the risk of an economic recession dragging down the entire stock market. But academic research in the area of modern portfolio theory has shown that a well-diversified equity portfolio can effectively reduce unsystematic risk to near zero levels, while still maintaining the same expected return level a portfolio with excess risk should have. In other words, while investors must accept greater systematic risk for potentially higher returns, known as the risk-return trade-off, they generally do not enjoy increased return potential for bearing unsystematic risk. The more equities you hold in your portfolio, the lower your unsystematic risk exposure. A portfolio of 10 stocks, particularly those across various sectors or industries, is much less risky than a portfolio of only 2 stocks, per Investopedia. To me, that's common sense.
Okay, so we can talk about systematic, unsystematic risk. Okay, my recording ended. I think it's still going. Hold on. Okay. So systematic risk we have is, okay, we will read this together. We highlight this part. It's market risk, right? Market risk is all the things you can think of that are not directly related to your specific company that you buy. Inflation, interest wars, war, Ukraine, recessions, currency issues, crashes, freaking runs in the market, all these things that affect the entire economy, systematic risk. Then you have unsystematic risk, which is also company specific, which is exactly what it sounds like. The specific risks related to the company you invest in. Okay. So, for instance, one of my favorite topics, let's say uh, SoFi's personal loan book blows up in their face because of the unsustainability of what they're doing. Wink, wink. That's a company specific risk, right? That is not a risk affiliated with JP Morgan or Caterpillar. They don't have that risk. And most companies have some sort of risk like this. Tesla has a risk of insuring their own vehicles, which is not a shared risk of Toyota. So there's the two types of risks. You cannot diversify out systematic risks. So diversification will help you with the specific unsystemic risks, right? Like I owned McDonald's. I have owned McDonald's, and McDonald's lost a huge chunk of their revenue when the Ukrainian-Russian war started because they closed all their stores in Russia. Okay, systematic. Now that's one's kind of unique because that was an unsystematic risk and also systemic risk combined, but it was more affecting McDonald's than other companies who didn't have such a sizable position in that country. So you can diversify the company side, but not the market affected side of risk. Okay. So now why does it even matter? Well, I mean, if you just look like let's be very simple about this. Here's the S&P 500. Here's the 11 sectors as it stands today. Right, it's 11. Should still be 11. But I'm sorry, 12. So we can see it's all over the place, right? The 11, I'm sorry, 11. I keep saying 12. So 11 sectors, and then there's the S&P's average return that year. So you can see, like, if I click, like, this was quite cool. You could see the returns over years. Look at the variation on different sectors. They're all over the place. So obviously the top is the highest return and the bottom is the lowest each time. So like all these sectors, right? They're scattered. So if you were to say, well, I'm just going to pick tech because I know that tech and healthcare are going to do great, and I think they're going to return better than the S&P. So obviously, this shows you anything above the S&P here did better than the S&P and below. But you could see there's a lot of variation in how each sector does each year. So I mean, this is not surprising to you. If you buy the whole thing, you don't have that risk. If you try and pick two or three of these sectors and say, "Oh, I'm going to outperform because I know tech and healthcare and industrials will outperform the market," you are taking on additional risk, right? You're taking on more risk of underperformance, but then you have risk, then you could outperform the S&P 500. So we will go on and on. So where did some of this, I think all of you have probably heard of 30. I don't know if this is what I've always, people throw 30 stocks is what you should own to be a diversified portfolio. I've heard it for as long as I can remember. People say 25 to 30 or just 30. That's kind of the biggest number I've ever heard. I think some of that comes from this study. This is from 1970. So if we go, it was by two economists. So how many YouTubers? You gotta love this, right? How many YouTubers will go through research like this? So this stuff is terrible to read, but so this part, okay, they looked at size of number of stocks in portfolio from 26 to 65. This is old. Like I said, this is a 1970s paper. Okay. So this is the dispersion of the whole market, right? The whole market is 100, right? So here's a portfolio of 128, 101. Now you start getting more of a variance, right? The dispersion starts to increase the lower amount of stocks you have, right? Because you're taking on more company risk as your portfolio of stocks is smaller. So the base is 100 because the whole market will have will have a 100% relationship to the market. There's no dispersion. So you can see 32 gives you it seems like a sweet spot, right? You're close to the market dispersion, right? And it doesn't, and then it starts to kind of go off the rails after 32. It starts increasing pretty fast. So that, like, this was kind of where I think the 30 portfolio came from. And here's another chart in this. You can see 100% of the return of the so percentage of possible reduction in relative dispersion achieved. Market's 100% because it's every stock, right? You still achieve 96% or 96 with 32 stocks. And then you can see it starts to accelerate as you go down. All of a sudden, It goes off the rails. So again, 30 seems like you're getting a lot of protections of the whole market in a more manageable size. So a lot of the you're getting a huge amount of the benefits of holding every stock in holding 32 stocks in this paper. So this is from the 70s, mind you. I should also remind you that the way they came up with this, these stocks they picked are just random. Okay. So that's something to consider when you look at these studies. How did they pick these stocks? Random. So would you pick random stocks for a portfolio? No, you wouldn't. And if you do, I don't know why you're not buying an index. So bear that in mind with some of this research. So a lot of you out there, I'm staring at you in YouTube land, you're probably very heavily weighted in one specific sector. You're not even close to diversified. So if you had 30 stocks, you're probably very heavy tech because all you YouTube people are tech investors. I see it every day. You're all a bunch of techies. All right. And then you have one industrial just to say that you're diversified. So be it. But so that's one study about where it came from. So there's dangers of over diversifying though. So you can be under diversified and over diversified, which means you're trying to mitigate your volatility of your portfolio. Um, so you want to be diversified enough to mitigate some of the swings up and down in your portfolio to try and keep from losing too much money. Because if you're say you're all tech, right? We all know this. 2022, you got hosed, right? You got hosed really badly, and then that affects your total return over longer periods of time because then that's the bigger the hole, the greater you have to climb to get out of it. So by being diversified, you're trying to mellow out some of that volatility as best you can over long periods of time. um, there's a risk of being too many stocks, right? So a lot of stocks in the market act together, right? They don't provide any additional benefit. So in this example, they were talking about 20 stocks, looking at the volatility levels, stock specific risk. So as you have stock specific risks that are very high, and as you own more stocks, that starts to taper off to the market risk, which you can't diversify out of market risk, right? So a lot of studies, the number of stocks to go from this peak down, that's the question. A lot of the studies vary that I've looked at. So the one you just looked at from the 70s, 30 seemed to be where you got a good amount of diversification, but then you still maintain the returns of the market, um, so forth. Okay. Mhm. I don't want to talk about this one. So, like real life example, the best I could think of recently, if you look at the last 2 year or 3 years, technology and utilities have kind of had an interesting relationship. Technology did really well. Utilities did really bad in 2023. 2022, utilities did really well. Tech did bad. So they inversed, which was very interesting for that small amount of time. So just as a small example. So here's a portfolio. Portfolio number two was, I think, what I put it at 70%. 70% tech, 30% utilities. I didn't do 50. Nobody's going to do 50-50. So this is kind of like someone could realistically have done this. So you're still mostly tech, but you've added some utilities. Um, so how did that perform in the last few years? You still got the vast majority of the return in the diversified portfolio, but you can see the standard deviation went down. Your best year obviously is not as good as tech, but your worst year wasn't as bad as the worst year of tech, right? You've kind of narrowed the performance, right? The drawdowns are not so sharp. Um, and you might say, well, I'm a 20, 40-year investor. Why do I care about this? I'm like, well, maybe this keeps you from doing something really silly, like selling tech when it goes bad. So if you're all tech, maybe you were in a bad place in your life and that 27% drop of that tech was too much for you. You couldn't handle it. You thought it was falling off a cliff and then you sold. So maybe if you only lost 18%, it kept you in the game. That's the biggest part of diversification that I see. And certain sectors can take such a nosedive that it's like it'll affect you forever because you just can't recover from that much of a drawdown. So this is just a short example from something I noticed recently. So we'll go to some research. There's 3 papers I pulled. How long? What are we at? 14. Yeah, this was going to be a shorter video. Okay. So this is a review of past studies. This one I will link the I think I can link these underneath. So this was this research paper looked at past research on portfolio diversification, which is kind of cool. They even did like a scatter plot of all the studies that they've looked at. So I'll go to the very bottom. They didn't put a chart in here, which was I was hoping they would. Okay. So here's their conclusions. After thorough analysis of all the studies, it can be concluded that an optimal number of stocks that constitute a well-diversified portfolio does not exist for whatever market period nor investor. This work has proven that evaluating a number of assets which lead to optimal diversification is not an easy task, as is impacted by a huge number of different factors. So they talk about systemic, right? Unsystemic risk, the frequency of the data being used together with time horizon conditions in the market that study refers to. One of the problems with much of the literature regarding optimal portfolio diversification is the range of opinion on what is considered effective diversification. Yeah, the question would be, what do you consider effective diversification? Some people could say you should have stocks if you're going to just be all individual and no indexes. They're going to tell, well, you should have like stocks from all the sectors, right? Maybe that's what one person's opinion of diversification. Somebody else might say diversification only matters as far as its effects on drawdown, right? So an inverse relationship. So like tech, I showed you had an inverse kind of relationship with utilities in the last few years. All right. So there you could argue that was diversification to have those. But what if there's two stocks that, correlate and they move together with the markets pretty similar? I mean, is that diversification to own both of them? Not really. So somebody looking at this from a mathematical standpoint would have a different opinion from other people. So this one did make this one part was interesting. More recent evidence, because this is more recent, 2021. More recent evidence highlights that the size of a well-diversified portfolio is larger today compared to past studies, which could mainly be caused by lower transaction costs. So I thought that was interesting. So I did notice that. So older studies I looked at from like the 70s and 90s were saying like like it seemed like from the data, if you were like, let's just eight to like 30 was enough diversification to get enough stocks to get the benefits of diversification. But I noticed a few of the newer ones are starting to push to say you really need to be like 100, 200 stocks to actually start seeing benefits of diversification. So I think you could see a trend in the studies. It's getting bigger these days than it was in the past. Um, so here is a book. This is literally a book. I think I can link this, page 57. I'll show you what the book's called first. Modern Portfolio Theory Investment Analysis. Okay. So I've had this for a while. Um, so it's page 57. Hopefully they don't sue me. Okay, here you go. So they talk about portfolio size in this one part, average variance of a portfolio 7. So they're looking at just the New York Stock Exchange. So you can see here's their risk percentages with number of stocks. And you can see they kind of get to 20-ish, where it seems like you get most of the gain of risk diversification at this point. A lot of these graphs do this. There's always a decrease in risk the more stocks you own until you own the whole market, but obviously like the benefits start to shrink really fast as you get to a certain point in these graphs, right? And then the increase in diversification doesn't seem to be enough benefit to actually take on the company risks that you're going to take on with more stocks. So this one is telling you 20-ish is enough. Um, here's a UK study. All right. Where was the variance chart? Okay, this was the chart I want to show you. Expected portfolio variance, right? So one stock, quite a bit of variance, right? So we're tapering, and you can see it once you get to about 20, 25, you kind of have got most of the benefit of the portfolio variance protection. And then after about 25, you're not getting much more benefit according to this. Okay. So there's that opinion. Now, this was one I wanted to show you. So this one, so I'll show you the cover. Okay. It's from another journal. This is the most recent one, 2022. So this one, they just did a simple mathematical formula to do this chart. so I don't really derive much from it. It doesn't look much different from what I just showed you, right? The most of the benefit of diversification, you're at like 20 stocks. This was the one where it was more of their opinion. Um, this was one they actually, now this is again, they use random selection of stocks when they did this, right? Not human was not picking these stocks. It was random stock selection. Okay. And then they used a mathematical formulas. So we have terminal wealth multiple compared to number of stocks in portfolio. They're showing you, this is what I want to show you, that you get diversification benefits up to like 250 stocks before it starts to actually mitigate and start reducing. So, like right here, on the other hand, a portfolio of 250 stocks had a 1 in 10 chance of achieving less than a 17x, uh, what was it, terminal wealth multiple, only 10% below the expected outcome. The unlucky 250 stock investor ended up with a 40% greater end wealth than the unlucky 25 stock investor. So, the risk of or the expected return chance or percentages were better with a 250 stock portfolio than 25 in this study. Um, so again, we're around we're going up, right? The more recent analysis is increasing. So, and then they have portfolio volatility, which is unsurprising to any of you. So here's the different sizes. 25, you have much more volatility in your portfolio compared to reduce. Now they don't go perfectly in order. You can see the size 100 actually is not the next one. So actually the 200 was more volatile than the 100 in this graph that they ran. Interesting. I can't, their research is behind a paywall, unfortunately. All right. So average portfolio return is different. There's your different variances in that. So here's what I would tell you. It's like, why you have like you have tools, right? You have indexes. So my first question to you would be, why are you only in individual stocks? Because that's my first question before I even answer. What do I think the optimal amount of stocks you should hold for benefits of diversification, and like to me, protection from the unknown of the markets? My question, why do you not have ETFs or indexes? I don't understand that. So, but it appears that a lot of the benefit, personally, like if you were going to hold individual stocks, it goes beyond just diversification. I don't know how you're going to follow. Like even if you did believe that one study said 250 stocks, you're not following 250 stocks. So I'm going to believe you're either spending your whole day every day looking at the stocks and their performance and calls, or you're just randomly picking stocks because you think it diversifies you. If you'd have that many stocks, I can't imagine um, owning 40 even. I had 40 at one point and it was overwhelming. I kind of went crazy during COVID buying dividend stocks, but I've pared it down to like 16 at this point. The ones I really believe in the performance of them. I believe in these companies' performance. Um, and I will stick with them. So it wasn't even it wasn't necessarily a decision about diversification. I was more about what's a manageable amount of companies I care to track and keep up to date with their ER calls, not listen every minute of all of it. But here's some different opinions again from Gen X dividend investor. He said these are what some people that you think are famous have said. Warren Buffett, 15 to 20. Research wise, from older research, that gave you a lot of the benefits of diversification, like we showed. Like, yeah, 15, 20, yeah, get you enough diversification. Random picking research said that. Kramer 10. Um, I mean, the benefits start to taper off the more you take on, which we've seen. So I think 10's a little light, honestly, but so be it. So here's some different people. I mean, I look if I had to tell how many stocks do I have, like if you count the indexes, individual holdings, right? And obviously overlaps there. I probably have 1,000 stocks. Like if you count the indexes, because you got the S&P, I have international, I have factor investing with some small cap. So yeah, I'm probably exposed to about 1,000 stocks, which is probably good enough. I don't think I need more than that. So I'm curious, if do people care? Like, do you consider this? Because I think the more important question is how many stocks do you actually believe in? Because that's like that'd be my first question. Like with these great ETF products out there, if you're going to buy an individual stock and tell me you're going to hold it long term, like you shouldn't be buying it to be diversified. You should buy that stock because you believe in it and you think it's going to do great. And like I've said, you should be believing that individual stock's a grand slam investment. Because if you just believe it'll give you a normal return, why don't you just buy more index or factor investing ETFs, stuff like that that has track records of working? Um, Interesting topic. I don't think there's any specific answer to this. So that's this video. Next video will be quality versus value investing. Yeah, I'm gonna do that. That's I've been wanting to do that. It might be a 2-part video, but I hear so many YouTubers that I to me, like, they think they're value investors, but they really sound like quality investors to me. I think they mesh the 2 concepts together. I don't generally, I think they just don't know what the hell they're talking about. They say they're a value investor because they think they sound smart, and it makes them sound closer to Warren Buffett, which people recognize. So everyone just slaps that they're a value investor or growth investor on their channel so that they can attract views to me. But I'd like to go into it more. So that's this video. Rambled on enough. Give me your thoughts. I will put some of what I showed below on this topic. You can get so in the weeds on this topic, the math. Some I'm not going to go through all of it, but I think you get most of the benefit from what I looked at. Honestly, when 15 stocks give you a pretty decent amount of diversification at that point. I think the 30 doesn't hold up these days. I think as little as 15 can give you enough diversification because some of the companies you're going to pick are so large, um, and in so many parts of the world, they're going to give you, I think, a lot of diversification just by holding some of these large companies by themselves. Because I think it has changed since the old days. I don't know if I necessarily believe you need hundreds of stocks, but you wouldn't buy hundreds of stocks, right? You would just buy the S&P 500. And there you go. So thank you for watching, and we'll see you on the next one.